Hello and welcome to the Business Standard Morning Show. I'm Vinu Sandhu. Let's take a look at the stories for the day. Winter is no longer pleasant in North India. One after another, fields of Punjab, Haryana, and Uttar Pradesh are erupting in fire, turning pitch black. Smoke and ashes emanating from them are engulfing Delhi and its surrounding regions. For over 2 months, farmers continue to set paddy straw on fire with impunity, despite government warnings and incentives to desist from the practice. On Wednesday, Punjab recorded over 3,600 incidents of farm fires. And the next day, Delhi's AQI touched hazardous levels. Punjab's share in farm fires is maximum this time. So why has the government failed to prevent stubble burning in the state? Here's our report.
Winter smog and air toxicity have become an annual affair in Delhi, and as we speak, millions of Delhiites are struggling with it, breathing air which is laden with toxic contents. The national capital's air quality on Thursday morning worsened to the severe category, according to Central Pollution Control Board data. At 8 am, Delhi was India's most polluted region. Its air quality index, or AQI, was 419 at that time. Air pollution at that level is not only a serious problem for those with existing diseases, it also affects healthy people. News reports said that people were complaining of choking and a burning sensation in their eyes. Against this backdrop, the Delhi government has implemented curbs on polluting activities under the Graded Response Action Plan, or GRAP. The overall air quality in Delhi is likely to remain in the severe category from the 3rd to the 5th of November. It is also likely to remain in the severe to very poor category on the 6th. The overall outlook from the 4th to 9th of November is that air quality will likely remain in the very poor category. This is what the centre's Air Quality Early Warning System for Delhi had to say in its 3rd November bulletin. By Sunday, over a quarter of Delhi's PM 2.5 pollution was coming from stubble burning in neighbouring states. For some time now, paddy straw burning in Punjab and Haryana has been a major reason for the high pollution levels in the national capital in October and November. Farmers set their fields on fire to quickly clear off the crop residue before cultivating vegetables and wheat. This year, however, farm fires in Punjab have come in for increased criticism. On Wednesday, Union Environment Minister Bhupender Yadav tweeted that there was no doubt that farm fires in Punjab had turned Delhi into a gas chamber. The minister also highlighted how Haryana had seen a drop in such incidents. Meanwhile, Delhi Chief Minister Arvind Kejriwal has blamed the centre for rising incidents of stubble burning in Punjab. While the politicians duke it out, let us see what the data has to say. Punjab's cumulative farm fire cases between the 15th of September and 1st of November in 2022 rose over 18% compared to the same period in 2021. Meanwhile, Haryana saw a 31% drop, and at almost 18,000 burning events, Punjab clocked over 8 times as many incidents as Haryana did during this period in 2022. These were the findings of ICAR's November 1st bulletin after monitoring paddy residue burning in India using satellite remote sensing. So, what did Haryana get right? As the state strives towards zero burning in the next few years, it adopted a multi-pronged approach to address the issue this season. Reports said Haryana carried out extensive campaigns on the ill effects of stubble burning and promoted 3 particular machines that help in disposing of crop waste. The government provides farm machinery for stubble management on 80% subsidy to custom hiring centers. Stubble management machines were deployed extensively in October and November in 351 identified villages in the red zone. where 6 or more active fires were reported in the Kharif 2021 season. To prevent crop residue burning and to ensure that machinery available with farmers and custom hiring centers is utilized to full capacity, 3 officials in red zone villages and 1 in 753 yellow zone villages were deputed. A district-level control center reported active fire locations on a real-time basis, so nodal officers in the field could immediately douse them. Farmers also got a 50 rupee per quintal incentive amount and subsidy on straw management equipment for making stubble bales. Then, what about Punjab? Delhi CM Kejriwal recently said that the centre had rejected a plan to give a 2,500 rupee per acre cash incentive to farmers to curb stubble burning. Under the joint Delhi and Punjab government proposal sent to the centre in July, the two states would contribute 500 rupees each and the centre would contribute 1500 towards the incentive. The centre rejected the proposal, saying that it was providing subsidized machinery to farmers for the on-site management of paddy straw. Farmers say a cash incentive would help them cover the cost of fuel used in such machines. But are there any other reasons that Punjab can't put out the stubble fires like Haryana has?
So what Haryana has done and what Punjab could not do, there are a couple of things. One basic thing is that amount of money which the central government gives for Haryana is slightly less than what is gives for Punjab for the same amount of scheme for in situ management of paddy straw through using machines and various types of equipment. Now, it has to be taken also to be understood that these machines, in case of Punjab as well as in case of Haryana, but more in case of Punjab, the cost of production of paddy is much higher. So if you have an additional expenditure on the farmers for buying these machines, even if what amount of subsidy you give, even if it is 40% subsidized, even if it is 50% subsidized, if it is used just for 15 days or say at max 20 days in a year, it does not have a value for the farmer. So the next best option is that you have a custom hiring center process where a common pool of farmers come together, they buy this machine, then they hire it for this 15-20 days so that nobody has to bear the excess expenditure. For this, the central and the state governments together give almost 80% subsidy, both in case of Punjab as well as in case of Haryana. My understanding is that in case of Haryana, this custom hiring center thing is acting very efficiently, while in case of Punjab, it is not being done very efficiently. There are not many custom hiring centers. The second big important aspect here is that the political will. In case of Haryana, the implementation of the schemes, the strictness with the deal with farmers who indulge in paddy burning is far more severe than what they do in Punjab.
One possible solution can be giving a separate cash incentive to farmers in Haryana and Punjab every year for paddy stubble management. Authorities can measure the program's success, and if they find that farmers have not stopped burning stubble after 2 to 3 years, they can take action against them. For such a plan to work, all the stubble burning states, Delhi and the centre, must sit down and thrash out a solution. The ideal amount of incentive, the manner in which it will be given, and the share of the states and the centre will also need to be agreed upon. The bottom line is that a durable solution must be found to gas chamber Delhi.
The impact of air pollution is as devastating on our economy as it is on our health. According to a study, it costs Indian businesses around rupees 7 lakh crore every year. Moving on, there is a haze of uncertainty on the global economy as well. No one really knows what lies next. So how can banks brace themselves amidst global concerns about a possible recession in 2023? Also, are fintechs making banks less relevant? And is the dominance of public sector banks healthy? My colleague Manojit Saha and I spoke with Professor Douglas Diamond, who won the 2022 Nobel Prize in Economics, for the answers. The Nobel was awarded to Diamond along with long-time collaborator Philip Dybvig and former Federal Reserve Chair Ben Bernanke for having significantly improved our understanding of the role of banks in the economy, particularly during financial crisis. Here's what he has to say. Welcome, Professor Diamond, and heartiest congratulations on the Nobel.
Thank you very much.
And thank you for taking time out to speak with us. The global economy is once again facing steep challenges, and experts are increasingly beginning to say that we might be looking at a recession in 2023. Now, how can banks brace for something like this? And are there lessons that they can dip into from the 2008 financial crisis?
So let me start with the second part. Because of the 2008 financial crisis, banks, independent of changes in regulation, have already pre-positioned themselves with bigger capital buffers over and above the amount they're required to hold. So that's just the bank's own behavior. You know, they have to have X% capital, and they have X plus 3% capital. So that's recent memory of a crisis gives individual institutions incentives to be a little more careful. And probably more important, the regulations have made them hold more capital, you know, which means they have fewer deposits and more equity. So they're a little more secured. So I would say in a lot of the world, the commercial banking sector is in a more resilient state than it was. So that will prevent a pretty small shock from bringing the system down. Obviously, a big enough shock could bring it down. So I think the banks are in better shape, being more careful and have higher lending standards, being more transparent about what their standards are. So they tell people we're being careful. That's probably what if I was running a bank, which thankfully I don't, I like to be a professor, that would be what I would do.
We have seen a tremendous rise of fintechs in the last few years. Now, does fintechs make banks less relevant? And more generally, what kind of role and presence do you see for banks in the future?
So fintechs, there are lots of definitions of fintechs. Let me define them this way. Fintechs are institutions that do a lot of the things that banks do and did, but using a different platform and using different technology to evaluate borrowers and lenders and things like that. I would say fintechs are the shadow banks of the current time. Shadow banks are the things that do banks activities without being called banks. So I'd say it's an issue. Fintechs have got to look out for them. People have said for a long time, now that we have X, banks are toast. They're going to be done. Now that we have such low bid-ask spreads in financial markets, everybody will always finance all their stuff with equity. We won't have any banks. That was clearly when people were saying that 25, 30 years ago. Now that we have fintechs, there won't be any more banks. That's probably not true either. This fundamental thing in society that there's a profit from borrowing short-term and lending long-term, that's just there. If you make one institution unable to do that, another institution, which what Divya and I in our second paper called replacement intermediaries, now known as shadow banks or fintechs, it's just going to move elsewhere. It's sort of like whack-a-mole. You'd hit one thing down and it pops up someplace else.
Indian banking sector is dominated by public sector banks, the government-run banks. They control about 2/3 of the market share. Do you think this kind of dominance by state-run lenders are healthy, or is it time the government should privatize its own banks?
So I'm actually, unfortunately, not an expert on the Indian banking system. I can just tell you what I know about the evidence from around the world. That government banks around the world tend to do more sort of politically connected lending than fundamentals-based lending. So that could be a good thing or a bad thing. The bad thing if the political connections are through, you know, your brother-in-law or your party member, and I lend you money for a bad business, that is definitely a thing about politically connected banks. The other thing is that they could be lending to parts of the economy that need more encouragement and development. You know, so that's sort of the trade-off. The good news is that maybe because they don't have to totally maximize profits, if the government has a goal, they can allocate capital a little bit. The trouble is there's no way to leave it at a little bit. Once the government or the government official, even worse, is allocating the capital, you get this sort of crony capitalism of going to your quote brother-in-law. So that's the trade-off.
Again, in the Indian context, we are heavily dependent on weather, which plays a critical role in price movements. So what would like to know that whether do you think inflation targeting framework for the monetary policy works in countries which are where the external factors are so much influencing the prices.
So it's hard to think if a central bank wanted to have a goal to make sure it didn't let inflation get out of control and inflation expectations get out of control, the most natural target is actual inflation. Now, your point, I think, is a very important one, that if you have things that move prices, this is not inflation necessarily, move prices up and prices down, you can't just use today's inflation, including the goods whose prices move up and down for reasons other than general excess demand in the economy. So if you have an inflation target in such an economy, you need something that looks at that is sort of your own version of core inflation, which is like wages and the prices of these crops that don't so much move around with weather. So you need to try to look at what we call the headline inflation, includes all that stuff, and the stuff that doesn't. And you also need to look at sort of a long run moving average. You don't want to look at just today's inflation. Prices jump 10% and they're going to go down, 12% tomorrow, or if the weather gets better. That's not inflation, that's price movements. It's very hard to tell the two apart. So it's harder to have a really good target if you have these things where it's really depends on weather. Or think about, India thankfully is a well-diversified, very large economy. Suppose you ran a small island economy where half the output depended on one crop. Even if your weather is fine, the price of that one crop could make your inflation move all around. That would be an even worse situation. But you need to do, central banks, you need to give somebody a goal. This is even true if you have an employer-employee relationship. The employer should tell the employee what the goal is to make sure they can try to deliver. So if you want central banks to do their job, you got to give them some kind of a goal. And I think inflation targeting isn't such a bad one, even in India or anywhere.
Thank you so much. Thank you. Congratulations again. Bye-bye.
Thank you very much. Bye-bye.
Rising interest rate and liquidity withdrawal continue to put pressure on global equity markets. After the Russia-Ukraine war, fresh geopolitical tensions are seen brewing in some other regions as well. Now, will these worries affect markets globally? And are they a bigger worry than the central bank's policy action? Find out in our next report.
Following the Russia-Ukraine crisis early this year, global tensions across several other regions are currently on a rise. For instance, North Korea has reportedly fired at least one ballistic missile towards its eastern sea as part of its weapons test that have raised tensions in the region. Meanwhile, Saudi Arabia has shared intelligence with the US about an imminent attack on the kingdom by Iran. These fresh geopolitical worries, analysts warn, could prove to be a bigger concern for the markets over the next few months rather than central bank policy actions.
Geopolitical situation happening in very crucial part of the world definitely has a major headache for the markets and also for the growth, economic growth and stuff. Because it leads to a lot of disturbances, not only in terms of supply of crucial energy, which is needed especially during this time of the year when the winter is likely to be harsh, but it also has an impact on certain nations with respect to the food security. Now, both these events are very important and integral to the markets across the globe. And in case if there is going to be any unfortunate misadventure by certain part of the leaders in respective countries, then definitely it will have an overhang more than the inflation concerns or the growth rates slowing down. Geopolitical tension will come at number one when it comes to likely possibility of what can impact the markets in the future.
Sharing similar views, G. Chokalingam, Chief Investment Officer at Economics Research, says, Major world economies cannot afford a slowdown now. As it is, the world economy is reeling under the impact of the Russia-Ukraine war and tensions between China and Taiwan. Any further escalation will impact growth and markets that have not yet fully priced in this possibility. Meanwhile, on the policy front, the US Federal Reserve delivered a 75 basis point rate hike on Wednesday, cautioning against prematurely pausing the tightening cycle, which dented investor sentiment.
But stocks, of course, we can see didn't like the language, and the S&P was down 2.5%. That's the worst performance of the S&P on a Fed decision day since January 2021. Futures are basically flat in Asia this morning. The way I would interpret it is the Fed wanted to acknowledge that a lot has been done. And we know from some of the commentary over the last few weeks from people like Vice Chair Brainerd, San Francisco Fed President Daly, Chicago Fed President Evans, that we know from them that some Fed officials think 75 basis points going forward is too much for the market to handle. So they wanted to signal that they might scale down the pace of the rate hikes. But they also knew going into the meeting that so many market watchers were already saying the Fed's going to be less hawkish, and the S&P had risen 10% from its low on the 12th of October. The Fed doesn't like it when the market is in control. It likes to be in control. So it took back control by saying that, yes, the rate hikes will be less big, but they'll also be more spread out, so it'll last longer. I would say that having already had such a good October, up 8% in the month of October, the S&P could easily give some of that back, but we think it can grind higher between now and the end of the year. Technology is still a sector that's in some turmoil. But the forward-looking inflation readings are continuing to show that inflation is coming down.
However, analysts now expect the US Central Bank to slow down its pace of hikes going forward. Philip Murray, a senior US strategist at Rabobank International, said he expects a 50 bps hike in December, followed by 2 hikes of 25 bps each in February and March, which would take the top of the target range to 5%. According to Murray, inflation is persistent and it will take time to bring it back down toward the US Fed's 2% target. The FOMC will remain on hold for the remainder of 2023 after reaching the terminal rate. That said, Aditya Birla Fashion, Cipla, Britannia Marico, TVS Motor and Escorts will be on the street's radar today, ahead of their September 2022 quarter earnings. Foreign investor flow and the level of the rupee will also guide market sentiment.
Back home, the Reserve Bank of India's Monetary Policy Committee held an off-cycle meeting on Thursday. It was called to discuss the unrelenting inflation and give a response to the government on it. In the last report, we explain why the RBI is writing to the government over inflation.
The Reserve Bank of India's Monetary Policy Committee held an off-cycle meeting on Thursday. The central bank's rate-setting panel usually meets bi-monthly to decide on interest rates. But this off-cycle meeting was for different reasons. It was called to discuss and draft a report to be sent to the government. RBI has to give an explanation to the government if it fails to keep inflation in a fixed band for 3 quarters running. The central government in 2016 provided a statutory basis for keeping inflation under control with a specific target framework. The government mandated that RBI and its Monetary Policy Committee, with all the monetary tools available at its disposal, will keep inflation at 4% with an upper tolerance limit of 6% and lower tolerance limit of 2%. To this effect, the government amended the RBI Act and entrusted the central bank with primary objective of maintaining price stability while keeping in mind the objective of growth. If the inflation stays above the upper tolerance limit of 6% for 3 consecutive quarters, or the average inflation is less than the lower tolerance level for any 3 consecutive quarters, it is considered that the RBI has failed in its mandate to achieve an inflation targeting framework. Now, when that happens, the RBI has to send a report to the central government in which it has to explain the reasons for failure to achieve the inflation target and what actions does the RBI intend to take to bring inflation under control. The central bank also needs to explain in the report an estimate of the time period within which the inflation target of 4% will be achieved. India's consumer price-based inflation has stayed above 6% since January, hitting an 8-year high in April. Price rise, triggered by various geopolitical reasons and the Russia-Ukraine war, has caught many central bankers off guard. The RBI, on its part, started monetary tightening in May with an off-cycle interest rate raise and has since hiked the benchmark rate by 190 basis points. The consecutive hikes have taken the borrowing costs to pre-pandemic levels, but inflation is still at elevated levels.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
RBI Governor Shaktikanta Das has said that the MPC's letter to the government will be made public at some point. However, he said that the details will not come out in the open immediately. That's all for today. For more news and analysis, please log into our website www.business-standard.com. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.